Okay, so in this part of the video, I think I'm on part 4 actually, I'm going to discuss the DCF model in the context of an M&A transaction. Now, to make a DCF model, we initially have to make a forecast. And what I don't want to do is to discuss the forecast kind of too much. For once, I just want to really focus on the valuation once you have the forecast. I'm going to talk about the forecast just a little bit, okay? But I tend to, and I think others probably do too, focus a little too much on the forecast and not on the nuances and the things that are interesting about the about the DCF, which I'm almost reluctant to say it. Okay, so here's what this valuation survey did, which was kind of interesting. It really took me back for a minute. They said that uh, uh, whatever they used CAPM all the time, and they used the long-term Treasury rate, which has a whole lot of inflation risk in the CAPM. Unbelievably bad, really, and they only project for 5 years, or they project for 5 years, which is arbitrary. You're trying to, from a philosophical standpoint, you're trying to figure out when this company will have its business and its products in a state where it will be kind of in a boring state, in an equilibrium state. And then they say that terminal values are typically computed on using the Gordon model, our famous Gordon man. Okay, and then they say that, well, when you use only 5 years and you have a pretty, well, depends on the discount rate, but they say that terminal value comes up to 70%, and then they say, okay, you can, if you use the multiples, of course, it collapses to just a multiple calculation. Now, to introduce uh, the DCF, here's what I typically do. This is I've talked about this elsewhere, but I think it's really worthwhile doing. This in a way introduces a financial model, so I'm being a little bit contradictory. Okay, in this, I gotta put this back here. In this output, which I remember, I've told you before, I remember using in the 70s and all this, and I still think it's good because it really illustrates that you want to focus on getting as much history as possible. And this is one of the things that I don't like about life. I'm sure if you maybe have Bloomberg, you can get some longer term history. But by looking at this history and just by looking at a couple of things, in particularly the return on equity, you can get a good handle on whether this long-term boring kind of company, remember this is, I didn't say it, but maybe this really applies to a kind of boring company that's been in business for a long period of time. They have here a price and a PE ratio, and up here they have the estimated earnings per share. And look at the estimated earnings per share is supposed to, well, it was growing. Okay, it's supposed to grow. Well, we had a deficit, and then it grows, and then it's supposed to get up to 12.65. And the current stock price is 85, but the real thing they're doing here is making a projection of the stock price, and then they're putting an annual rate of return, which is an IRR. So this little example kind of puts things together. Now, if we very quickly, I think what I'm going to do is even in our DCF model, why don't I do something that I've never really done and put our little thing here. So we have a current price of 88.55, and then we put our high projected price of 180 and a low projected price. Notice I'm going a little more slowly today. Maybe I'm just relaxed, okay? And let's put an average. And what did I just know? I had an average beta or something. So that's our average price. Now, the way they do a DCF model, and it's really just a DCF model, but it's on equity cash flows. They put their EPS, and what they might do is they have a forecast for 2015, and who cares that it's old? I used to get all worried. Oh no, I'm not coming current. Who cares? Okay, and let's make one. So this is 2000, and it's not going to be exact. This is our terminal value period. Okay, and so we have an EPS here. It looks like of 8.9, and then we have an EPS in the next year of 9.75, and then in our terminal year we have an EPS of 18.80. And if I really wanted to do this, we could put, let's just try this, 2016. I've never done this one. 2019, and we'll put our little thing here. And we could, let's see if I have the interpolate. I have the interpolate lookup, and what we could do is click on this thing, and then click on this entire line, and then click on this entire line, and it would give us the little interpolate lookup, and I'm very happy about that because I've never done that before, and it didn't give me a disastrous result. So let's put up. Oh no, I spoke too soon, didn't I? Okay, whatever. I'm going to leave that there, and then let's see about this. Well, that works. Okay, let's put our dividend per share. The reason I'm putting the dividend per share is because the dividend per share, unlike the earnings per share, is the real cash. And that's when we compute our IRR, we're going to have to take account of that. So we'll put the 2.66, 2.95, and then underneath, and then we skip over to 2019, and we put 3.90. Okay, so our dividends are going to go up, and we can put the historic amount in, and then we can do the same calculation. Let's try that again, equal lookup. Now, to get this interpolate lookup, you need to go to my website, and once you go to the website, you need to download or get the function into your model, okay? I'm kind of afraid that Excel is going to have this, put this function in there, okay? Maybe not. It's really a demonstration of how you can really fix out Excel. It's kind of unbelievable that they don't have an interpolate function, isn't it? Okay, it's one of the few functions I would use, lookup and interpolate and index, and that's it. Okay, now let's, once we have the earnings per share and the dividends per share, let's do our valuation. So for our terminal value, we can put a terminal value multiple. And our terminal value multiple, in this case, is the estimated PE. And they have this long-term kind of history. They had some negative earnings and didn't have some PEs. And it went 16, 13, 16. And then they put a higher value. And maybe that's, in a way, that's not bad because the multiples in the markets have been going up. And the reason they've been going up is totally, completely clear is that the cost of capital is coming down. You can get that when you ask people what the kind of return they can get on a wind farm with merchant risk or something like that. You can get that. So then we can take our this terminal multiple was a PE ratio, and then we can get our terminal value, which is the PE ratio multiplied by the earnings per share. And what did I do? In 2017, I put 2016 as 9.25. 2019, it was 12.65. And I don't know what I was just doing. I put an incorrect number in, of course. And then this is the number. This is their forecast. Not surprising. Not surprising at all. And then that they come up with the number. And then, I don't know. I didn't put the down there that they had the date. And I'm going to assume that this. Do they have the date here? Can't see it. Oh, okay. So the cash flow. How about this? I'm going to start here. It might be wrong, and I'm going to put a minus on the 88.5. And then I'm going to assume we don't get any more dividends for the year, which might be wrong. And then I go over here and kind of compute them. I should have done this. And then in this last year, we, of course, I say, of course, we add our terminal year. I said, of course, because I made a mistake. Okay. And then down here, we can get our IRR. And when we get our IRR, we're not going. They don't have the kind of base case. They just have a high case and a low case. So let's put an equal IRR and get the whole number. So we get a 17%, which is nice. It's between here. Okay, but that's what they're doing, and that's valuation. And I'm going to leave this in the file. I'm going to put value line DCF. It's an equity DCF. Fine, who cares? But that's anybody does. That's got a typical valuation. Now to do this, the nuances come in. First of all, we got. So let's do what we really can do. What we can do since it's a history, I put this. This is just Yahoo Finance, and I hope I've got the right thing. We've got Daimler, and their current stock price is about 45, not 100. What was it supposed to be? It was supposed to be 150. The low case was supposed to be 120. Okay, do you think the investment analysts go down and said, oh, look at our old report, we were wrong. And here's why you might think that they were wrong. If you look in this one, perhaps I'll make it a little bit larger. For me, the first thing I look at is this return on equity. And this return on equity jumped up to 17%. And even in this year, it was 15% and 14%. And if you look at all these averages, including the recessions and everything else, when it went to be negative, it never achieved that. Now, I guess Daimler Chrysler had divested, and it was Daimler Chrysler before. Maybe they divested Chrysler, and maybe there was a good justification for that. But that's in general the check, and it's exactly corresponding. It exactly corresponds to all of this business that I was trying to emphasize about. Look, I can't get a word out. Using the return on invested capital, and that return on invested capital, or return on equity, whatever you want. let's not get obsessed with things, is a key check. And that's basically, if you look at project finance, that's all you're looking at. Okay, now I'm going to do something I promised I wasn't going to do so much. No, I'm not. I was going to go through the model. God, I gotta start editing these things and making sure I don't. So when we do our valuation, there are a couple of things I do. I always make a flexible timing and always make kind of a half-year adjustment. You don't want to assume that all your revenues come in the beginning of the year or the end of the year. And then the big issue is terminal value. And I want to focus on terminal value. So we get our free cash flow, can get our equity cash flow. We're discounting our free cash flow and discounting the big terminal value to today. And we can say that, well, we could take our equity cash flow and debt cash flow and get that. And we discount this at the cost of equity, this goes to debt. So we should discount free cash flow at the weighted average cost of capital. And then we should do a little timeline and use different terminal values. And I've just put a little presentation that's really, you can hardly read, of how Salman Brothers, who are they now, whatever, Citibank or somebody, I think, how they put small differences in WACC. Here they put small differences in WACC and didn't get a really big thing, and then they put the equity value, and then they used in this case, they used a net income. They used a PE ratio for the terminal value. Use whatever you want. But I'm going to go through now and really try for once to really explain this whole business of different terminal values, and there are some mechanics and how to do this correctly and incorrectly. And I go crazy, really, because everybody uses this stupid damn Gordon's model. This guy who just wanted to increase cost of capital for utility companies. All he wanted to do was, when he did his model, he went backwards to derive the cost of capital, and all he did was say the growth rate is high, so the cost of capital is high. I can't stand it. All right, that was enough digression. Okay. So I call this the growth rate method instead of the Gordon's model. And then we'll talk for a minute about using EV to EBITDA multiples. And then we'll talk much, much more about 3 different ways to apply this 1 minus G over RSC divided by WACC minus G. And this one incorporates your indirectly or directly incorporates your estimate of the return on invested capital, which seems to be a big improvement over the growth rate method. But if you apply it wrong, it really isn't that much of a method. And the better way to apply it is to assume this company in the terminal year gets this new ROIC. So instead of this NOPLAT, which is got the old ROIC, and you replace this with the ROIC times the invested capital, which gives you the NOPAT, or NOPLAT, whatever you want to call it, and then you multiply it out. And then you're really assuming all of a sudden this company does it, but that's not right either, because it really happens gradually. And the way it happens gradually is supposed to be in this formula, but it's really, really, really not. And this is the formula touted by McKinsey. So I'm just going to walk through this, okay? And of course, I say of course way too much, but the whole business of a terminal cash flow is a philosophical idea. The idea that you're getting to a stable ending kind of state, okay? And it's a reasonable idea, because if you assume you're always going to grow really high, you're always going to fantastically make new products forever and ever and ever. Some companies make it for a long time, that's for sure. Or you assume you're going to get monopoly profits forever and ever and ever. Okay, but eventually that's difficult. Or if you assume you're really going to just always go bankrupt, every company is just going to go bankrupt, which might happen too, That's silly. So we make a kind of, it's like a Goldilocks kind of an idea, okay? And it's not so bad. And so the first method is just this integral calculus. It just comes from integral calculus. And here's the real problem. This, I snipped a little part of the DCF. I snipped a little part of it. And look at this. The terminal growth rate goes from 3.1 to 2.5. The WACC goes from 5.7 to 6.3, a very small difference. And this leads to the 65 versus 30. And if you do it with the EV to EBITDA, you even get 54 to 39, not quite as much of a difference, but that's the classic kind of a thing. And this is for Air Arabia Airlines. You can get these kind of analyst reports right off the internet. I think I forgot the name of the company right now. I'm losing it. My mind is becoming mush. But we can get, if we got a high growth rate and a low return, we get this, and a high one that. And I used to get obsessed and say, that proves that the DCF is complete crap. It's not really. The reason is this WACC is the rate of return you're going to get forever and ever. And if you can get a return forever and ever of 10% versus 6%, your value is so dramatically different. So dramatically different. And what's really, you can make an argument for what's happening in the markets today is that this WACC is getting really, really low. So that's one of the problems with the DCF. And then with the multiples, of course, we already went over this almost too much, but the multiples itself have an implicit growth rate, an implicit tax rate, an implicit asset life, and most importantly, implicit ROIC that changes. And really, it's the same as any of the other multiples, but it really leads us to the next one. So we could apply this formula, and I think I've tried to prove it too many times, and I've even done it in this series. So I'm not going to go and prove this formula anymore. It's easy to kind of demonstrate this formula with a little bit of math, not a lot of math. Okay, but then we can take this formula, and I said instead of applying with just NOPAT, multiplying the NOPAT by this, we can multiply this little thing, and you think, that's not a big deal. Why are you even talking about that? Why are you even bothering about that? But it is a big deal. Okay, and then we can present our multiples and do all of that. So now I'm going to, before we go through the different methods and show what they are, I'm going to just talk about the importance of normalizing the cash flow, which everybody talks about in concept and nobody does. I shouldn't say nobody does. And to provide a framework for this, I'm going to talk about normalizing the cash flow differently. Now, somebody gave me a slide in Hong Kong many years ago. I remember it. And I was supposed to be like a substitute teacher for him, I think. And he gave me his slides. And I used to think this is such a bunch of rubbish slide. I used to call this the rubbish slide. So this is our explicit period. We put our wonderfully accurate and precise estimate of what's going on for if this was 5 years or 10 years or 4 years or whatever. But then, instead of just assuming the terminal value automatically just goes bloop, bloop, no, you assume the ROIC gradually fades. And you assume the growth fades to the GDP growth or the real GDP growth, or you put just inflation in, or just make the return fall to the cost of capital, which I think is an absurd assumption. So that's why I used to criticize it. But this idea, I've had a totally rethinking of this graph. I think this graph is now really kind of cool because we don't have to fade it all the way to the cost of capital, but it can fade and it can take a really long time, or it can go immediately. And in your terminal value, it forces you to think about what the real drivers and the nuances of a terminal value are. And finally, when we suddenly start changing the growth, that's what causes a lot of these normalization adjustments. Okay, and when so now I'm going to use this kind of graph in this terminal value with this ROIC, 1 minus ROIC divided by WACC minus ROIC. Now, I had naively assumed before I read this thing that everybody, I thought we made some progress since the 1970s. I really did. I thought, okay, Gordon did his silly little book, and then I really thought things must be improving. Everybody must be doing something much more sophisticated than a simple Gordon's model. And I think that's wrong. I think people still use this stuff. And here's an example of just the silliness of it all. This is this company we just looked at up here. This was the Air Arabia, okay? And what they did here is they put ROIC. So the first thing they did, which is very nice, when they presented their forecast, and it's out on the internet, and of course it's an old forecast, sorry about that, but I'm stopping worrying about wasting all my time updating everything. Suddenly, here's some history of the ROIC. Suddenly it's going to go up. It's going to go up because they increase the price. If they increase the price, good luck getting your utilization up. I've taken Air Arabia. It was real pain to take it. And the same thing, look, the ROE has an even more kind of stark thing. And the important part about this one is this drives everything. And how could you possibly, if you saw this forecast, how could you not throw away this thing? And just to kind of finish this off, this company, here's what they said. They said the value, the Air Arabia in AED, we'll put Air Arabia stock price in Air AED could be from 1.24 to 4.89. So let's see what happens. Okay, how about we put Air Arabia? Okay, and maybe it's not on this one. Sorry. Stock price. Okay, let's see if they give it to us in the right currency. And it's in. Okay, it's in, and it's in dirhams. Okay, and where am I? Let me go back here. So the first thing is that I opened my slides on M&A instead. First thing is lower than all of this. We had this wide range, and it's lower than this. And you say, that's because of this pandemic. You're kind of cheating. Okay, so let's see what it was. And in 52, it went down to 0.87, and let's put a 5-year thing here. And in the 5-year, it never really got up. Maybe it got up to that 1.46, which was the very, very lowest. Look at him. Hello, Mark Forrest. Okay, it maybe got up there once, so it was lower than the low. It was lower than the low. Okay, and I think that's enough of that case study. If you don't examine the ROIC in your projections, and if you don't look at that both for the terminal value and for the projection period, use that in the terminal period. I just think it misses everything. That's why I started. That's why I started. This is part 4 already of this valuation. I'm talking a very, very long time, but I really just want to get this finished. Is focus on the ROIC. Now, when we do this, if we're going to use the Gordon's approach, we start with EBITDA, and we have to make sure our CapEx and our working capital is correct. and I need to put I made a little function called stable capex. And if you have a higher growth, you're going to have a higher capex. If you have a higher growth rate in EBITDA, you need a higher growth rate in capex to supply that. How could you not do that? It's so it's so completely obvious, isn't it? A higher growth rate, you can't grow your personal income. You can't do anything unless you make an investment to support it. And the same goes for working capital. If you suddenly have a drop in the growth rate, you better put a drop in the working capital that supports the growth rate. And here's a little formula I made. Now you can use this with other techniques and everything else. Okay. Now, but if you use NOPAT, if you use this method here, this is interesting. I'm actually using PowerPoint slides that I'm shitty at and and that I hate instead of using Excel. Maybe I'm getting old or something. Well, I am, but maybe where is it? I'm looking for a terminal value methods. If you use this NOPAT, there's no capex, there's no working capital in this NOPAT. The working capital and the capex are part of the invested capital. They're part of the IC down here. And we don't have to worry about normalizing in the same way, but we do have to worry about normalizing. We do have to do that. Okay, so please, if you're making these forecasts and you're making these forecasts using a Gordon's method, I hope you rethink it. Now, what I did here, and this is what I also believe in so strongly, and I've shown it to you in the Excel. I'm almost about to go into the Excel, but I just stopped myself. Okay, that if you make this theoretical value, this goes for 400 years or 500 years, and you just put a growth rate in and you start out with you put a cost of capital in and you start out with some kind of I didn't put the starting invested capital here, did I? No. And if you have if you go out 200 years and you take the NPV at the rate of return, and this is the rate of return of 10%, and you discount this as a cost of capital at 6%, and you grow at 3%, then this is your value. You can easily do that in Excel. It takes a minute, okay? But then you can say, no, let's stop in year 10, and we'll stop in year 10, and then we'll make our 1 plus G, the whatever, the free cash flow times 1 plus G divided by K minus G. We do that. Or we can stop in year 10 and say, okay, take the NOPAT, not exactly the cash flow, the NOPAT multiplied by, in bracket, 1 minus G over ROIC divided by K minus G. You can do that. Or you can say, no, let's take year 10 and all of a sudden let's just stop it there. Okay, and then finally you can say, no, let's put a fade period in, and this time the fade period is irrelevant because we will use an interpolate function and we don't even have to worry about that. Okay, now let's just change it. And this file, by the way, this file is one of my now new favorite files on the disk. It really is, because whatever. I've spent years trying to prove this crap, and I think it's getting close. And the next issue is, okay, let's assume that we are 10% return on capital. I'm just going to call it return on capital because in this case I have an all equity framework and I haven't redone this with EV to EBITDA. I just kind of do it with PE ratios. Okay. So if this was EV, you'd take EV to EBIT. In this case, this doesn't have taxes and everything else, which I need to put in. Okay. But the issues are exactly the same. then what you do is, in this case, you have a growth rate, and the growth rate just changes from 4 to 3, not a big change. Okay, now when the growth rate changes, you have to support that growth rate. So in this case, if you did you need less invested capital going forward to support that change. Now, this is normalization. And in that last year, just stop in that terminal year, and let's say you just took the actual cash flow, which has cash flow minus capex, and the capex and working capital that supports this number go down. And if you don't adjust this, if you do not adjust this cash flow in that last terminal year, you're going to get a big error, and you're going to understate the value. Okay, so the first thing you should do, and here's how it kind of works. The way I set this little model up is I put an opening balance of our invested capital. I made like a dividend and a reinvestment, which you could call capex minus depreciation. And here's the opening balance, and you add the net income, and you take away the amount you need to reinvest, and you get the closing balance. You go to the next year, and in the next year, you grow by a lower amount. And when you grow by a lower amount, what happens is all of a sudden the cash flow goes up, because you're able to pay more out, because you have to put less capex in. To grow at 3%, you put less capex in, and that occurs in the year after the terminal value, when you make the opening balance go up by 3% or 5% or 4% down to 3% rather. Okay, now if you do it here and you put that growth rate in, you put that in the terminal value, so suddenly you can take out all this money in the terminal year, and that cash flow is what you're going to use in the Gordon's method. That's dividends, that's cash flow, and then you fix it. Now we're back to every single method giving us the same thing. Okay, that's that one. So far we've learned one thing. If you take that Gordon's method, that Gordon guy who increased your electricity bill, if you take his method and you fix it, you better be really, really careful in that terminal year. It's like fixing the capex and the working capital, but it's a different framework for doing it. Okay, now let's do something else. We have another case, and in this case we take the return, and we suddenly say, oh no, suddenly our return is going to go down in the terminal year. We're not going to be able to earn our really high monopoly profits forever and ever. We're not going to differentiate our product. People are not going to be addicted to our products forever and ever. One day it's going to go down in that terminal year. And in the terminal year, instead of changing the growth, our cash flow stabilizes with a lower return. And when we do that, our theoretical value, that's kind of interesting that it was 184. It's not changing the way I thought. Oh, that's because I started with 12 and went down to 9. Okay, the theoretical value over the infinite 400 years is this. Okay, and when we do our Gordon's method and these two methods, we get a crazy result, because when we're changing, this changes this return. This return changes in after the terminal value period, and I'm getting a little bit yes, because in our explicit period we're taking the cash flow, and we're just taking the explicit period, the last period cash flow, growing it at our growth rate, discounting it, and everything else. But if we use this other formula, where we just explicitly put in the opening balance. I'm having problems here, but if we take that, uh, uh, if we assume, if we put the different terminal value formula in, then we're getting the, excuse me, excuse me, if we, instead of using this formula, which takes the old NOPAT that was still in that explicit period, if we change that and take the invested capital at the beginning of that period, right at the end of the terminal period, and multiply it by our new ROIC to get a new NOPAT, now we can see what's going on. And now you can see that the terminal value is fixed and it explicitly accounts for the ROIC. And I almost hope that you go all the way back, you know, to the we don't care about this one, do we? This is where, you know, when I did this evaluation, maybe I should show you how it's going to look. Okay, when I did this, I started by saying, okay, we recognize that our values are not going to be accurate. We make our football field diagram. We put in our ROIC to assess the forecast right away. We become a boring company. That's the whole business. And then when we do that, we recognize that value depends on not only growth, but return on investment. And we recognize that we are going to maybe, in this powerhouse company, if we were up here, we're maybe going to be here, okay? Or we're going to maybe be here, we're going to be at a lower growth kind of company. And everything we're doing, every theory about the valuation should have some sort of return that you think about. I know I'm repeating myself, but that's the idea. So I put these on the website as well. Of course, I'm going to give you this PowerPoint slides, and most importantly, the file that this comes from. Okay. Now, finally, we get to this interesting one because here's this slide I was moaning about, and we have a gradual fade, and this, you might think somebody in I remember in Denmark, they said, oh no, this method here, this value driver method, correctly accounts for the fade down, and it's got some kind of theoretical thing in there. That's complete mumbo jumbo. Complete mumbo jumbo. So I put a stable rate here, and our growth rate formula makes nothing, and we have now an enormous difference. And our basic value driver formula from McKinsey is a disaster as well. The sudden one isn't so bad. It isn't so bad, but if we explicitly put in a interpolate function and do kind of like what we were doing with our EV to EBITDA ratio, where we started and say, gradually the return is going down, gradually the growth is going down, it's almost as if you're mimicking the 300-year, but putting it year by year over a selected period. And you can do that however you want. You can do that however you want. So in the DCF, for me, this is the crucial part of it. Really getting kind of the terminal value and all that right. Okay, and I just cannot understand. It's just beyond me why there are such smart people in the industry, I think, and why we don't get it right. Now, when we make our model, a lot of people focus so much on the model, they should, in this case, I said we have this pandemic and everybody wanted to do this pandemic stuff, and we put some scenarios, and in our scenarios, we said, okay, we're going to put some different recoveries in and all that. And what we need to do, or what I want to do, is put in historic things that are just annual, and then make our financial model work with some different history. And I should have started with the timing, shouldn't I have? The timing we put in, we spend a lot of time, maybe more time than anything else, on setting up our timing in a sophisticated way. We put our starting the history, and then we get some annual, and then I actually put in a valuation period for in just a minute later, and then we put in our time period, and then we put how many months per period we want. We don't want to do it month by month by month in this period, and then maybe we want to go quarter by quarter by quarter. And please, I used to be so afraid and so intimidated by doing all of this, but don't. Okay, and then you can put in your which exact period. What's the period that you start? So we've got 4 periods of annual. The next period we start our monthly, and then we multiply it by 12 to see how many years of monthly data, and then we go to quarterly. And the key thing is, when you set up your financial model, just set up the monthly periods and the quarterly periods with little flags. So if it's less than, so if it's less than 4, we go to be monthly. So you set this all up with just a simple little period counter, and you put a couple of flags in. And after you put the flags in, now you can, of course, look at this. You can say, okay, are we using 12 periods, 3 periods, or 12? How many months in the period? Do we have 12 months in our period, 1 month, or 3 months? And you just multiply that by the little true and false flags, and then you can use some sort of e-date or EO month function to get it all set up. And now what we did then is we took an actual company, and then you take your historic analysis and get some basic kind of ratios. And the more I do this, the more I understand. It's number 1, easy. And number 2, following some bureaucratic rule would be the worst thing you could ever do. You have to figure out how you're going to really model your revenues. You might have all sorts of different ways to model your revenues. So I made some scenario analysis, and I put some different cases in with different price and quantity forecasts in. And then finally, when we do our valuation, I hope I have a little graph here. And in the little graph, I show, oh, this is our different pandemic case. And then the big thing is, what's happening to our ROIC? And you better compute the ROIC, and you can, instead of working through for the umpteenth time how to do that and try to explain that, you can look at the model. And ultimately, when you get the model, you can see what I did with the class. I allowed people to put in their EBITDA and all that. You can put in your different terminal values and then put your little bridge in to the terminal value. And finally, when you have your model built, this could be your target company, I suppose. You can then put in some assumptions about how much you're going to pay for this company. You can put in your different terminal value assumptions, and then you can put in all your financing, and ultimately work through, and I'm just going to stop here, you ultimately work through a pro forma balance sheet, get a new balance sheet for the transaction. Well, here's what I didn't do, because I'm just so sick of it. But you can look at so many other files on the disk to see how it works. Once you do this, you can use this new adjusted balance sheet with the goodwill write-up and everything else as the starting point for your new financial model. But whatever. There'll be some tax adjustments perhaps, and some synergy adjustments. And I think I tried to do it here with a little one of these waterfall charts or whatever, which, it's spent so much time doing this, and this is my waterfall chart. I didn't put a comma format here, but maybe this is our standalone value, and then we're paying a premium for the company, and then we're getting synergies, and this is our final valuation. So you start with your DCF valuation here, and you see what the kind of final value. And I don't know if I really should have put that. There are different ways to present that, that's for sure. So that's part 4. And now I'm going to talk about one more issue, and then I'm going to be finished with this M&A course. And remember that this is, I better put this in, this is just a course review. And what I hope you do is you think about, if you're watching this video, you're not going to watch the whole thing, I guarantee you. And you're not going to go through the Excel, and you're not really going to think about this. But if you take my online class, please think about it. Please think about it. I really want to have you thinking in an open, with a more open mind about some of these issues, and all the videos and everything else will be part of this slide. Here's where it is. You go to the home page. I just redid my home page because I'm trying to do a little more marketing, obviously. And then you go to the M&A things, and then you go to your M&A theory and analysis, and that's where I've tried to put the key things in, and you'll have access to the slides and this nice model my friends who took the class really worked through. Okay, so that's part 4.